The greatest speculative bubble of all time in all things, according to hedge fund manager Michael Burry of The Big Short fame, burst in the summer of 2021. The mother of all collapses was coming, and it will be worse than the recession, he told the ordinary investors piling into joke stocks and cryptocurrencies. But what made him say so? What could be worse than a recession? So in this video, we're going to discuss why Michael Burry said such a thing. Is it a warning of a huge stock market crash? Let's analyze it. The S&P 500 and NASDAQ indices declined by 19% and 33% respectively in 2022, which may indicate that the dire prognosis made by the Scion asset management boss is about to come true. Burry claimed credit for forecasting the sell-off in tweets that were published in May 2022, but later removed. He also stated why he anticipates further drops and warned against investing in rescue rallies. Number 1. The pandemic collapse was just the beginning. Since the pandemic collapse in the spring of 2020, the S&P 500 index has seen a significant recovery, climbing from a low of 2,192 points to over 3,800 points right now. On May 3, 2022, Burry tweeted that it may lose half of its worth and fall to below 1,900 points during the next several years. Burry pointed out that the S&P 500 has historically traded lower years after a collapse. He cited the fact that the index's bottom was 13% lower in 2009 than it was in 2002, 17% lower in 2002 than it was in 1998 during the long-term capital management scandal, and 10% lower in 1975 than it was in 1970. According to Burry, if the benchmark index trades in line with the past, it may be 15% below where it was in the spring of 2020. Number 2. There could be magnificent but brief rallies. This year, Mr. Burry anticipated a few dead cat bounces. A dead cat bounce is a brief increase in stock prices after a sharp decline, sometimes a result of investors buying shares to cover their losses. In a tweet on May 4th, Burry noted that they often take place amid significant stock market falls. The conclusion is that investors shouldn't get too excited about any rallies that may occur in the next months, since they're probably going to be short-lived respites rather than the start of a market recovery. Burry pointed out that 9 of the S&P 500's 20 highest one-day rallies happened in the wake of the 1929 Great Crash, while 12 of the 20 biggest one-day rallies in the NASDAQ index occurred when the dot-com bubble burst. Number 3. Don't let rebounds in stock prices deceive you. Burry said in a tweet on May 5th that there may be more rises in the stock market before the fall is complete. On the path to a 78% loss at its nadir, the NASDAQ recovered 16 times by more than 10% after the dot-com bubble burst, gaining an average of 23% each time. Burry further underlined that the Dow Jones Index saw 10 rallies of more than 10%, each time gaining by an average of 23%, following the Great Crash of 1929 until bottoming out at an 89% drop. Number 4. The stock market is moving dangerously. Burry remarked in a tweet on May 8th that the US stock market looks to be following the pattern of prior bubbles, putting it in a position for a catastrophic fall. The Scion CEO cited the S&P 500's recent 10-year trajectory, pointing out that it was very similar to the index's chart for the decade before the dot-com disaster and the Dow's trend for the 10 years before the Great Crash of 1929. Burry claimed that history is repeating itself and that human nature was to blame for the continuous decade-long buildups. Number 5. Burry makes accurate but early predictions. In a tweet on May 10th of last year, Burry seemed to celebrate, indicating that he thinks the stock market disaster he's been predicting has finally happened. The Scion CEO made light of the fact that, like the US property bubble in the middle of the 2000s, he was early with his prognosis. Burry nodded in agreement when Elon Musk referred to him as a broken clock last year after the Scion CEO had gambled against Tesla stock, prophesied its demise, and questioned Musk's motivations for selling shares of his firm. Number 6. Stocks are expected to fall much further. Burry said in a tweet on May 11th that investors should prepare for markets to fall far further. The investor pointed out that between Microsoft's high during the dot-com boom and its fall in 2002, 5.2 times the company's outstanding shares were traded. During the financial crisis, that number was 3.3 times higher, but at the time of his tweet, it had only risen to 0.5 times. Burry pointed out that the situation with Amazon and JP Morgan was similar, suggesting that it may take some time for those stocks and other ones to bottom out. So what did you learn from these? Post your comments in the space provided below. Thanks for watching.